We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, Head of Research at GoldMoney. Alasdair, thanks for joining me today.
That's my pleasure, Tom.
So it's been a little while since we've spoken. I actually can't believe it's been 7 months or so. It blows my mind to consider how much has changed in that time. And also, just the fact that it did in some ways feel like just yesterday that we spoke. But I want to start by talking about what some of the big shifts are right now taking place in the gold market that matter to you most.
Yeah, well, as we speak, gold is nudging into new high ground. I mean, it's around about $2,470.
And we're recording this, for me, the morning of July 7th.
Yeah, absolutely. And this is no surprise to me, really. I mean, I've been forecasting this. I don't forecast prices, but I forecast moves. And it's really very, very simple. It's not so much gold going up as fiat currencies going down, including the dollar. And that's the way to look at it. And if you understand that, then you can see that this move has only really just started. I mean, how long it will take for the dollar to disappear completely is we will only know in time. But that is the general direction of its trend. So unless we get a change in government policy, which by which I basically mean a very radical change and maintaining budget deficits in a sustainable way, then this is a trend which is going to continue. And I just don't see that, and particularly with President Trump appearing increasingly to be a shoe-in for the next president. Mm-hmm. I mean, he is an inflationist. I think it's as simple as that. So that's going to continue for the dollar. It's going to continue around Europe, and everybody's in a debt trap. I mean, when you've got 130% debt to GDP, which is the current situation for the US government, then there is no escape, particularly with higher interest rates. And I suppose the course of interest rates is something we'll probably cover in this podcast. Mm-hmm. So that I think is really the big macro picture. It's fiat currencies going down, being reflected in a rising gold price and also silver price, mm-hmm. because silver does have the characteristics of money. The important point to bear in mind is that gold and silver, but for practical purposes, gold is legal money in common law, and all the rest is credit, including fiat currencies. So if you want to escape from a collapsing mountain of credit, which is basically a collapsing mountain of debt, because that's the other side of credit, mm-hmm. then you can understand why people like the People's Bank of China are motivated to get into physical gold.
Mm-hmm. Well, Alasdair, it's interesting to try to consider, and maybe we can pull this apart a little bit, is the idea that, not only is the metric or the measuring bar by which we're looking at gold price going down, because as you explained, the dollar is actually going down. It's not necessarily gold going up. But also, when we consider the other side of that, how is demand also increasing at this point, and especially physical demand increasing at this point for gold as well? Can that be part of the explanation for the rise in the gold price?
Well, it is, and that's a very interesting point, because we've known for a long time that physical bullion has been migrating from west to east. China basically has absorbed an awful lot of gold, both the state with hidden reserves and also the people. Since the Shanghai Gold Exchange opened, somewhere around about 26 to 27,000 tons of gold has been withdrawn from the exchange's vaults. and that goes into jewelry and also bullion stored outside the system. And on top of that, there is bullion stored within the system, whose beneficial ownership is Chinese citizens through their bank accounts. So the demand has been enormous. Now, it is beginning to accelerate, and it's a number of unfortunate events seem to be coming together. The first thing to appreciate is that China's household savings rate is 35% of its GDP. Now, 35% of China's GDP is the equivalent of $6 trillion. So you have to ask yourself, where do those savings go? Well, property, it used to go a lot into property. I mean, basically, they used to, for the pension fund, quote unquote, they would just buy off-plan apartments in high-rise buildings in these new cities, and you just buy them and you just sit on them. I mean, they, maybe empty, maybe put a relative in it or whatever eventually. You use it if you visit the city. But basically, that game is over. Property prices are now falling. We know that the whole of the construction industry is in dire straits in China. So what else? Well, there's the stock market, but the stock market has been a bit better this year, but that is after 3 years of bear market. Now, I can see some of the household savings going into stocks, but very, very limited, because you're not going to get the bullishness that you would associate, let's say, with the healthy market. So that's out. And this is why the $6 trillion, the bulk of it goes into what are called certificates of deposit. Now, a Chinese certificate of deposit is basically a 3-year fixed deposit for individuals. And it's been going into those really for the lack of anything else. Now what's happening is that people are beginning to buy gold. So that 35%, $6 trillion equivalent, a fairly large portion of it is beginning to overhang the physical gold market. The reason that this can accelerate very quickly is that all Chinese banks offer gold accounts as well as ordinary yuan deposit accounts. Now, all you need to do is have the equivalent of about $70 in order to open one of these gold accounts. What the banks then do is they have to at least have some cover. I mean, I'm sure that they're fractionally reserved, but certainly not to the extent they are in the West. They need to have some cover, if you like. So as people open their gold accounts, then these banks have to go into the market in order to acquire gold. Now, they are actually very careful buyers. I mean, they don't necessarily go in and bid things up, but they will take anything that's offered to them, in effect. And this is why there is such a shortage of physical bullion in our gold markets, in the paper markets in particular. So it's a situation where now that prices are beginning to rise, going into new high ground, it's produced a sort of dichotomy in terms of behavior. In the West, until very recently, people took the advantage of these high prices, quote unquote, to sell their gold because they've been sitting on it for so long and, whatever. Anyway, they think, oh, well, we all
just
get
a
out.
pet rock for them.
Yeah, but Tom, this is the sort of behavior that happens at the bottom of a bear market, and yet we've got it going into new high ground. But the Chinese households are taking a completely different view. They're seeing the price of gold in yuan rising, and they're thinking, we better have some of that. So you can see that there's a beginning of a stampede going into physical bullion, even after something like 27,000 tons of gold has already been acquired by the public in China. So this really is going to drain all the physical liquidity, so far as I can see, out of the West. And this is why the gold price is rising and rising and rising. The interesting thing is that the People's Bank of China has been selling dollars to buy gold. Now, I put it that way round because it is official policy to reduce dollar reserves, not only in China, but throughout BRICS. So that's in accordance with that policy. But the important thing to understand is that China is selling dollars. That's actually what she's doing. But so what do you sell dollars for? Euros? No, certainly not. Sterling? No. Yen? No. So what you do, you go and buy real money with it. And that's basically what's happening. So we are seeing the first stage of a real macro trend whereby foreigners gradually move out of credit and go into real, legal, common law money without counterparty risk, which is gold. Mm-hmm. That, I mean, if according to the playbook, what then happens over a period of time is that the institutions around the world begin to recognize this more fully. Domestic institutions in America will begin to recognize it as well. So they will start getting out of credit and into gold. Perhaps say 10% of the portfolio at first, sort of idea. So you can see how the strains on the system are beginning to build. And I think we're in the very, very early stages of it. I think this is something which is going to be really very, very dramatic. So a lot of the dollar crisis, if you like, will be because of these extraordinary demand dynamics, which are building up for gold and to a lesser extent, perhaps for slightly different reasons, silver as well.
Mm-hmm. So then, Alasdair, let's talk a little bit about how, this, in some ways, this movement has also grown on the open interest in the Comex.
Yeah, open interest has risen very substantially. And I would take open interest as a very, very rough indicator of the degree of overbought, oversoldness in the market. I say very rough because you have to qualify it somewhat. Mm-hmm. What we've seen recently is that, yes, the managed money category, which is mainly hedge funds, has become more bullish. Now, you've only got to look at the chart, and you've got to look at maybe the recent weakness in the dollars trade weighted index to see that for a hedge fund, there is an argument to sell dollars, buy gold. I mean, we're talking paper transactions. So, yeah, that has increased. But the position certainly on the last commitment of traders figures was not actually that overbought. Overbought a bit, yes, but not alarmingly so. No, I think it's probably become somewhat more overbought. The thing that's interesting is that a lot of the increase in open interest has been because of spread activity. In other words, this is entirely neutral. Hedge funds and also the swaps have taken advantage, if you like, of price differentials, which have arisen for whatever reason between, say, different maturities, different strikers, whatever, in order to you buy one, sell the other. It's an arbitrage, if you like, to try and take something out of it. Now that is neutral. So quite a lot of the increase in open interest is in effect neutral. And I think that this is something which is probably not all that well understood. I would see that this market can get quite a bit more overbought. But I think the real issue becomes one of the mark-to-market losses, which the swaps, and by this really we're talking about bullion bank dealing desks, are facing. I mean, if you look at the losses between all the swaps on current prices, current positions, you're looking at somewhere between $60 and $70 billion spread around less than 30 reporters, as it were, within the category. This is, I mean, that's an average. So within that average, there are bound to be some which are quite a lot more. Now, I can just see, I mean, having been a director of a bank, I can see how the boys from the Treasury Department start knocking on the door and say, look, this is alarming, dealers. We don't like this position. What are you doing? What are you going to do about it? Mm-hmm. And they will have already done that several times and been fobbed off. Sooner or later, the Treasury boys are going to knock on the door and say, we're closing you down. Close your positions now. Now, what that does is it creates a further raft of paper demand, because where they're short, they've got to go out and they've got to buy those positions. So it's, in essence, quite a lot of this we can describe as a bear squeeze on the swaps. The other thing that's interesting while we're talking about this, Tom, is that the participation of the producers, the producer and whatever category, the producers, refiners, and all the rest of it, in that professional category, in the past, they have hedged their forward production quite materially into the Comex market. They're not really doing that anymore. And if you go back to the last time we saw prices peak, which was back in 2011-12, typically the producers were short of around about 200,000 contracts. Now they're short of only 50,000. So that the whole burden of the short side is effectively, apart from that 50,000, on the shoulders of the swaps. So this, I think, is a situation which could well lead to problems within the bullion banking community.
Absolutely, Alasdair. And this is exactly what I wanted to, get a handle on with you today. And for those that don't understand that these positions have to get unwound, this is something that, ends up creating, as you said, more of a mechanism to only drive the price higher. But you mentioned categories within the Comex. How do we split those categories up? And does that give us a better understanding of who's actually buying contracts on the Comex?
Well, it doesn't really, is the short answer. I mean, you can see in the weekly commitment of traders reports, the changing position of each category. But how is the category defined? I mean, for example, look at a producer who basically is a mine. How do they sell? How do they hedge their positions in the market? Well, they go through a bank like JP Morgan or Goldman Sachs or HSBC or whoever it might be. Now, it could well be that JP Morgan, say, leans on a producer and says, look, I think really you should hedge your production forward. And therefore, by advising the producer, produces, if you like, his intended result, the bank's intended result, in terms of trying to suppress the market. So, there are ways in which these categories find out in practice that they're not actually properly defined. I mean, the swaps is, basically the swaps are market makers. It's a sort of gaggle of smaller market makers and bullion bank trading desks and so on and so forth. Again, you don't know. I mean, all you can do is look at the bank participation reports and try and sort of juggle the numbers. The number of banks, let's say, short and long of gold, and and sort of marry them in with the commitment of traders reports once a month. So you can find a certain amount out, and then when it comes to you've got. For example, you've got the managed money category, which is basically hedge funds, because, these are what they call CTAs. You have to be a CTA to be, in that category. And then you've got other reporteds, which, are reasonably large traders who can be anything, like a central bank or, an extremely well-heeled, ultra-high net worth family office. And then you've got the other reporteds, which, are sort of slightly smaller, and it's basically a balancing item, if you like. Total number of contracts outstanding, this category adds to that, and there's a difference of that. And that's your, the non-reporteds. So, these things are approximate. The other problem is that we don't know to what extent there is hedging between London and Comex. Now, this occurs through the exchange for physical facility. Exchange for physical is the means by which you can exchange a futures contract for the underlying physical. Mm-hmm. Except in this case, the underlying physical isn't the underlying physical, it's a forward contract in London, which is not the same thing, as we know, because, and this is a problem actually that the LBMA is having, trying to get gold fully accepted as a high quality liquid asset at the Bank of International Settlements. As far as the LBMA is concerned, gold, it should be, and I would agree, it should be, a high quality liquid asset. But the sticking point there is that when you're dealing forward, you deal for forward settlement, you can sell that position out. In other words, you trade it and trade it and trade it until it actually gets delivered. Mm-hmm. And it's no surprise that when it comes down to delivery, the outstanding, let's say for delivery tomorrow, is sort of gone from that down to that. Mm-hmm. So, these markets are artificial. They are artificial demand for gold. Their unraveling is bound to create genuine demand for physical gold. Mm-hmm. So, this is something which I think we're actually beginning to see. And, when you see the, gold shooting up like this, when you see deliveries consistently coming out, standing for delivery on Comex, and this sort of activity going on, it just seems to me that the days of the paper markets are, well, perhaps not quite numbered, but their heyday is definitely behind them.
Mm-hmm. Alasdair, as you're talking about this arbitrage opportunity or this hedging opportunity between the Comex and London markets, it's interesting to me to also see the statistics and the arbitrage opportunity or price difference between the Western markets and the Shanghai physical exchange. So is that also, ending up draining physical out of the Western markets, especially London?
Yes, it is draining physical out. And the other thing, it's creating an arbitrage. And you can see that there is generally a fairly healthy premium in the price of gold on the Shanghai Futures Exchange, for example, and also the Shanghai Gold Exchange, compared with Comex or the prices in London. And that does create an arbitrage. And of course, this is the mechanism by which physical gold is effectively stood for delivery in London, if I can use the Comex term, and then it's shipped out to China. Now, whether it's a Chinese bank actually operating on the LBMA, or whether it is another bank, taking arbitrage itself is immaterial. I mean, the fact is that it is happening and it is continuing to happen. And this is the importance of this savings rate that I'm talking about. I think that the Chinese banks, are going to have to be in the market big time, really, to get every bit of bullion they can possibly get their hands on. Mm-hmm. And then, of course, we've also got another thing coming up, which anybody in this market must be beginning to think about. And that is the construction of the new BRICS currency, which provisionally has been named the unit, which, again, provisionally in the original paper, which someone very kindly sent me a copy of, suggests that it should be 40% backed by gold. So given that is likely to come in as a trade settlement currency, that's another reason why an Asian bank might feel compelled to build some sort of gold reserves.
So, Alasdair, I think there's another piece of demand that I think I'd like to explore with you as well, is this idea of a turnaround in ETF demand. Is that also providing another outlet or another source of physical demand for the metal?
Yeah, it's a very good point, because really for the last 3 years, people have been winding down their ETF holdings. This is all consistent with what we were saying earlier about how in the West we're still selling gold. Now that is basically seems to have stopped on a net basis, and the last two monthly reports from the World Gold Council have indicated that the ETFs outstanding are beginning to rise again. But I mean, we're talking fairly small quantities. But there is no doubt that as that trend continues, and it will do with the price of gold going up, because everybody's out of it effectively. And institutions will be buying gold through ETFs in order to gain that exposure. Mm-hmm. Then this is going to put a huge, great squeeze on the market. It is inevitable. When you've got the market already cleaned out by the East, you've got further demand, as I say, coming in from Chinese commercial banks. You have got the prospect of a new BRICS currency, all these factors. And then on top of that, if you get demand from ETFs, which I think is a very easy thing to forecast, it's going to happen, isn't it? Then that's just going to make the situation somewhat worse.
Yeah, I mean, it seems like all of this upward momentum is in a lot of ways unstoppable at this point because of all of these different sources of demand. Is there a part to this as well that once, family offices and these managed money funds really start to see the outperformance of gold, that they are in some ways forced to end up entering as well?
Well, yes, they're bound to. And probably for two different reasons. The one reason is a question of portfolio weightings. If the sector, if I can put it that way, commodities as a whole, and therefore gold, which is actually representative of commodities, goes higher, and at the same time, other sectors like tech stocks or whatever start going lower, and this is an interest rate story, really, then under those circumstances, yes, you're going to get suddenly a lot of demand. And I would have thought that one of the sectors that will really reflect this is the mine sector. I mean, already you've seen, some toes in the water being put into the sector. The majors are being bought. I think the next thing you'll see is M&A activity, whereby the majors, need future production, and there are no big gold mining prospects, coming on stream, and so they will start fishing around the minnows, particularly minnows which are close to where they are, and therefore logistically it's very easy to expand their operations into their territory, et cetera, et cetera. So all that sort of activity is going to happen. And I think this is where you get some real money made by people who know what they're doing within the sector. Mm-hmm. But of course, the other problem, Tom, is that no money has been invested in by brokers in mining research. So they're going to have to start from virtually square one. It's a consequence, really, of a sector being unfashionable for decades, in effect. I mean, and just going down and down and down in value because they are unfashionable. That is something. It's going to be. I think it could be quite explosive. An interesting thing to watch.
Well, and I think the other part of that, as you're mentioning, when the gold price goes up and these producers that are close to or almost under the cost of production right now, the margin expansion that happens as the gold price moves is going to revalue a lot of these companies instantly, right? And make them just that much more attractive.
Yes, it's bound to. I would caution one thing, and that is that you've got to look at the way in which their costs increase as well. I mean, energy costs are a very, very large element of this. The ability to get equipment from the manufacturers. I mean, you will find that as things start going, you can't get a hold of equipment. You can go and put an order in, and you probably find that it's your waiting list is 2 years. So you've got that sort of element. And you've got this new, environmental stuff which you've got to comply with. That's going to be incredibly expensive. So Yeah, you've got to sort of factor all these things in. But broadly, you're right. I mean, the leverage, the operational leverage, if you like, as far as a shareholder is concerned, could be very, very great. And I think initially, I mean, what I particularly like are the royalty companies because, somebody else does all the work, et cetera, and you get a royalty which, which basically is related to the gold price. So, there are different ways of skinning this cat, but a little bit of research, and I think anyone can really work out, the least risky way, if you like, for them to get involved.
So obviously, we've talked about the risks to these bullion banks having to close or buy back these short positions. But as you said, there's a big interest rate picture here to consider as well. So you and I have talked before about the risks to the banking sector in a lot of ways. The ECB and a couple other central banks around the world have already started to cut interest rates by the end of the year. And the dot plot is saying that the Fed is likely to cut by the end of the year as well. So does this start to ease some of that stress that was associated with the duration mismatch that stressed the banks that failed last March as well?
Well, I'd say dream on is the answer to that. I mean, the background to this, Tom, is the idea that inflation is yesterday's problem. Mm-hmm. That is a load of rubbish. The real driver of the loss of purchasing power of a fiat currency is the budget deficit. And the budget deficit in America, for example, I mean, it's funny enough, I've just put this together for an article which I'll release tomorrow. But if you look at the budget deficit, that is by far and away the most important definer of the loss of purchasing power of the currency. And I mean, we're looking at something like 9% of GDP, by my calculations, going back, because you've also got to factor in changes in the, in the volume of savings and things like that. Mm-hmm. And also you've got to factor in non-productive lending, which is basically the increase, if you like, of credit card debt and so on and so forth. It's all that non-productive credit going into the economy. That I reckon on my numbers is about 9%. If you get taking the second half of the last fiscal year and the first half of this fiscal year. Now that inflation is in the pipeline. Now, is it going to go down next year? No, it is not. And the year after? Certainly not. So the idea that inflation is yesterday's story is, I'm afraid, wishful thinking. I would very, very strongly argue that the evidence is that markets will take control of bond yields in particular, bearing in mind that the US government has something like 130% debt to GDP. It will find itself paying higher yields in order to secure its funding, not lower yields. The effect on companies, zombie companies, will be to drive them out of business. The effect on banks will be substantial increases in non-performing loans. We're already seeing this with the commercial real estate sector, for example, which has sort of wiped out, looks like it's wiping out about half total US bank equity. You've got foreign link into foreign banks. The GSIBs, the global systemically important banks, they're called that because if one of them fails, there are global ramifications. These are operators in financial markets and particularly in derivative markets. So you've got the whole of the mountain of derivatives, which, if you get a serious failure there, I mean, the repercussions are likely to be horrendous. So all these problems, I think, are why everybody hopes that interest rates will go lower. I mean, apart from the fact that they want their stocks to go up. But it's a systemic issue. Now, I think really there's sort of two ways in which this can be handled, but it ends up with exactly the same result, which is not good. I mean, the one is that the Fed lets the market effectively lead it by the nose in terms of its interest rate policy, and that way secure the to a degree anyway, the purchasing power of the dollar. Or alternatively, it decides that it's got to abandon the rate of the dollar and really look internally to try and prevent business failures in the domestic economy, banking failures in the domestic economy, and all the rest of it. And, I'm sure in the Fed, there's still people who believe that if you've got a healthy stock market, then that gives confidence into the economy. And that's a very important part of the whole picture. Now, under those circumstances, then you can kiss goodbye to the dollar's value on the international exchanges. But, and this is the interesting thing, apart from changing differentials perhaps between the dollar and the euro rates, I think really, this would really be shown up in the value of the dollar measured against the value of gold, because we're comparing a fiat currency which is getting into credit difficulties with real, legal, no counterparty risk money, which is gold. So, this again, this is a crisis which is playing into higher gold prices measured in dollars, I'm afraid. Either which way it goes, do they go with interest rates, be led by the nose by markets, which is something which they would be very reluctant to do. And it would break an awful lot of businesses. It could even break quite a lot of banks if they've still got bonds on their balance sheet with any maturity. Or do they abandon the responsibility for the currency and decide to just write an open check to rescue everything? And that's really what lowering interest rates at this stage is all about. It's that latter course. And we'll see which way they play it. But markets won't let them get away with it, I can tell you.
Alasdair, you were mentioning to me earlier that Trump basically being a shoo-in at this point, if that is the way the election goes, because we know there's so many different things that can change between now and then. If he gets in, being an inflationist, what does that end up meaning as well for these markets and really these price drivers that have wreaked so much havoc over the last couple of years?
Well, basically, all the indications are, and this is from his statements, and I would at this juncture say that we've got a very different President Trump or President Trump-elect, if that's how it works out, from the previous President Trump. The previous President Trump was a bit like a bull in a china shop. He's a far more considered approach to politics now. Now, having said that, his basic understanding of how to get America great again is basically to build a wall around America. Not just to keep immigrants out, but also to keep Chinese, good, efficient Chinese product and product from others out of America. And that way, try and encourage domestic production. Now, I'm absolutely certain that domestic manufacturers in America will be cheering him to the rooftops for this policy. But the effect of it will be to put pressure on prices to rise and rise and rise. And it will not, I can assure you, reduce the twin deficit phenomenon. Because in order for that to happen, you need to have an increase in the savings rate. And I just don't see anything in Trump's approach to encourage savings. If anything, what he is doing is his policies will increase the budget deficit. He believes in reducing taxes. I mean, we had this with Liz Truss, who tried to reduce taxes when she was very briefly prime minister, and was thrown out because of the fiscal consequences of her policy. We're going to have exactly the same thing with President Trump on current indications. So his trade policy, I think, is extremely dangerous. And also, I think his fiscal policies are also very, very dangerous. You cannot reduce those taxes without reducing spending at the same time. And no president, I think, has the ability to really reduce the spending side. Now, Reagan got away with it because the debt to GDP was nothing like current levels. We're now talking 130% debt to GDP. So, under Trump, his policies are going to drive that rapidly north of 150%, and probably in quite short order. That is not going to be good for the dollar. It's as simple as that.
Well, and it's so interesting to consider, this trap really that we're in at this point. And that, as you said, there's no real way, no politician is going to ever say that we're going to need to go through massive cuts to the budget to try to solve some of this problem. It, unfortunately, I think, time and history has proven that it's just going to get kicked down the road as far as it can before it ends up just creating an absolute mess that is inescapable, as math proves at this point, right?
Yeah, absolutely. And, governments do have this huge, great problem. They have mandated costs too. You can't just turn around and say, right, we're not going to pay unemployment benefit anymore, and that'll save us X billion dollars.
Exactly.
You can't do that. You have to pass laws in order to relieve the government of that responsibility. So they're in a simple trap. And, I've said this so many times before, and there are so many similarities with the 1970s today, with this sort of inflation. Actually, it's not going away. It's going to continue, and it gets worse. And it's sort of, the interest rates and bond yields sort of go up, down, and all the rest of it. I mean, we had a crisis in this country in 1976, and it led to the issue of gilts, which are government bonds, with coupons of over 15%. Just imagine what that does to US government finances. And if you say to me, well, perhaps there's nothing that's going to make yields stop rising at 15%, I would have to agree. I mean, it could go to anything. And principally because a lot of the financing, and certainly the setting of yields on the margin, is done by foreigners. I mean, we've seen that China is reducing its exposure. Japan is reducing its exposure. Those are the two big ones. Now, the difference between the two is that in China's case, it's the government. In Japan's case, it is financial institutions, pension funds, insurance companies, and so on. And they are making losses on their foreign bonds. And so if they're going to retain, say, dollars, then what they will be doing is they will be selling long bonds to buy treasury bills. In other words, get the duration bit out of it. A lot of them don't want to take the losses. So they're holding on to, say, 10-year bonds or whatever until maturity. There are lots and lots of hidden losses, but one thing they're not going to do is going to add to their positions by buying more. And if you look at the total dollar exposure of foreigners, according to the US Treasury tick figures, you're looking at around about $32 to $33 trillion, which is more than US GDP. That is a lot of credit in foreign hands, which being reduced will impact the dollar very, very heavily.
Yeah, and I mean, there's so many mechanisms by which they can reduce this exposure. And of course, there are examples like Japan needing to sell treasuries to, in some ways, manipulate or support their currency. But that ends up coming at the expense of the bond market, or they try to keep, as we have seen in the past, that's not necessarily occurring now. They're trying to keep a lid on the bond market while that ends up coming at the expense of the currency. So it's, as you say, it's a really a double-edged sword that is unraveling slowly. This is a process, right?
Yeah, and it's not just America. If you look at around Europe, around the UK. I mean, G7 nations are, all have a debt problem I mean, in this country, we're looking at about 100% of GDP. France is about 110, going on 115%. And it's worth mentioning France because at the moment they're trying to form a government which will be highly socialistic, communist even, which is bound to lead to enormous selling of French debt by foreign institutions, particularly the Japanese. We've got the same problem in this country. I mean, because London is the largest financial centre in Europe, the ownership of sterling in foreign hands is exceptionally large. Now, at the moment, everybody's sort of thinking, well, the new government is going to be responsible. But I mean, this is pie in the sky stuff. They're not. They're highly socialistic. They're not going to achieve anything. They're going to make the situation worse. And I mean, we can have a whole podcast about that. But just take it from me, that is going to be the situation. So we're living on hope here. And the idea that sterling, which has rallied to about, $1.30, that will eventually go down to, I believe, par with the dollar. So, for anyone, for any Brit, this is a wonderful opportunity to get the hell out of credit and get in, sterling credit and get into gold, because there is a 30% uplift just from the change in the relationship, which I see between sterling and the dollar. So, but markets, they're just not looking at this sort of stuff. They just don't seem to appreciate it. It's all based on hope. And this idea that interest rates can decline and decline and decline is the biggest load of stupidity that I have ever seen in markets. I mean, I've seen some very, very badly mispriced markets, but this takes the biscuit. It really does. Outside bubbles, if you like.
Mm-hmm. Alasdair, we've all no doubt heard about the great taking, whereby shares you own are ultimately in a default situation. They end up belonging to the clearinghouse, who is the primary creditor. So do you see this as a risk at this point worth mitigating for in these times where there's so many of these, existential risks to the financial system?
Well, yes, I think I would encourage anyone to actually understand what credit is. I mean, if you, let's say, own shares in a corporation, then that is credit. Even if you've got a certificate, it is credit. I mean, you think you've got ownership. No, you haven't. What you have done is you have bought into something, an obligation. You have acquired an obligation whereby the management of the company promises to deliver you a series of dividends or accumulate income on your behalf as a shareholder. Mm-hmm. This is credit. Worse than that, this system, which has been brought about in the name of efficiency or whatever, whereby you don't have a certificate anymore. You've just got an entry on a sort of combined register run by a clearinghouse, in effect. That is an extra layer of credit because, technically, the clearinghouse now owns all the certificates, as it were, and it has to you an obligation. An entitlement. It gives you an entitlement. So it's got an obligation to deliver that entitlement to you. So you have got two layers of credit between what you think you own and yourself. Mm-hmm. This is pig on pork. It really is. Now, the reason this has been done, so far as we can see, is that the clearinghouse then has a pool of securities which it can access because it will still have the obligations to everybody. Yeah, mm-hmm. Because they've got the certificates of entitlement, dematerialized certificates of entitlement. It still has the obligation, but it can take its ownership, if you like, of the credit in the form of the share certificates and use that as collateral in the event that there is a crisis within the system, within the settlement system, a crisis that would presumably arise from something like a global systemically important bank going belly up and not being able to deliver on its obligations in the market. That's what that is about. And this is, I would say, something which you should worry about, certainly. And it's another reason to just get the hell out of credit. That's my view anyway.
Is that, just in some ways another form of a bail-in that's not necessarily, tied directly to your checking or your savings account?
Yeah. I mean, I think probably a bailout. Well, it's a bail-in, bail-out. It's not quite the right terminology, but I know where you're going with it. To which the answer is broadly, conceptually, yes. Because they're taking something that you think you own and deploying it in another way. I mean, this is something that also happens with ETFs, so far as we can see. I mean, particularly the gold ETFs, which is another reason why I wouldn't hold an ETF, because all you've got is a credit. You don't actually have the bullion. You've got an entitlement to it. But that entitlement can be moved into other hands. So you can have two owners of the same entitlement. You don't know. And that certainly happens. I mean, it certainly happens with authorized participants, as they call them, shorting the stock, borrowing the stock so they can deliver it into the market, going along to the trustee and encashing, their sale, as it were, into bullion, and then taking that bullion and deploying it as they see fit within the market. So, what's happened? What's the integrity in the whole system? I mean, that's just one example. But you are right to draw everyone's attention to this. It's a very, very big risk, which nobody, except very, very few people, really do understand. And it's all, in order to understand it, you've got to understand what credit is. Everything works on credit. We don't do anything with money. I mean, by money, I mean gold or silver. You don't go and buy things with gold and silver. You hoard it. And in times of trouble, you hold more of it. When everything's going tickety-boo and lovely and all the rest of it, you don't need to hold it. But that is not the situation now. I mean, we're looking at a situation where higher interest rates will destabilize the entire Western financial system. Destabilize it, I think, really at some stage very, very dramatically.
So even if we hedge this risk by, let's say, buying physical property, let's say for now we're excluding gold and silver and metals, is there still really a reliance on this credit that you're still not escaping?
Yes, of course, because how do you value your property? You value it in credit, in dollars, Canadian dollars, pounds, whatever. And I mean, the proof of this was really dramatically shown in the collapse of the paper mark in 1922 to 23. I mean, property became virtually valueless in real terms, apart from anything else, because the cost of maintaining it was worth more than the property itself. So that was one consideration. The other consideration was that a property might be valued at a few trillion Deutschmarks, but what is a few trillion Deutschmarks? Probably a loaf of bread and not much more. And that so the distortions from a collapse of the value of credit it is total. I mean, it just wipes out. It wipes out the middle classes. It's an enormous burden on the lowest in society. Pensioners, workers with no savings, and all the rest of it. I mean, it is a catastrophe. So what I'm talking about is not going to be any fun whatsoever. But you do need to protect yourself, your family, and to a degree those around you from that situation. I think it behoves anyone to take a responsible view of, how likely is this collapse of credit going to be? What can I do to insure against it, in effect, which is what we're talking about? I mean, you can't go to an insurance company and do it because the insurance company might not survive. But, the insurance basically is to have sufficient gold and silver to see you through at least the initial stages of this.
Well, Alasdair, as we see this, move in the world towards backing some of these systems and even some of these new currency systems with physical gold and silver, how is the BRICS Alliance growing right now? And what are the the next steps to the progression or the evolution of this alliance?
Well, yeah, I mean, the history of this essentially starts with the Russians looking at how to construct a new trade settlement currency for BRICS. Originally, it was Sergei Glaziev who was appointed by Putin to look at this problem for the Eurasian Economic Union, which basically were the stans, if you like, Soviet Union stans, if you like, between Russia and China and, North Tibet. Glaziev actually wrote a paper for a Moscow business magazine called Vodomosti. This was about nearly 2 years ago now, where he made a very, very strong case for putting the ruble back onto a gold standard. So we can see which way his thinking is going. And last year, ahead of the BRICS summit in Johannesburg, there were very, very strong rumors put out via RT, the Russian television service, and also by the Russian embassy in Kenya, of all places, that they were going to put this new gold-backed currency on the agenda for the BRICS meeting in Johannesburg. Mm-hmm. It didn't actually make the cut, and it didn't make the cut, I think, because China didn't want it at that stage, because China could see it would destabilize everything in the West, that is. And furthermore, India didn't want it. So you're talking about the two most populous nations, if you like, in the BRICS system. So that was put to one side. It is, however, the indications are that it will go on the agenda for the BRICS meeting in Astana that's in October. And we have seen, there's a paper which is a sort of early proposal of how this might be constructed. And they're talking about this trade settlement currency consisting of 40% backing by gold and the rest of it currencies. And the paper actually was not all that well put together. There were big areas of confusion, in my view. There were lots of questions raised in the whole thing. Now, it may well have been tidied up somewhat and some of these issues addressed, but it looks like we are going to see another attempt to get this on the agenda by Russia. And bear in mind that Russia has the chairmanship of BRICS in 2024, this year, and is organizing something like 200 meetings to do with BRICS. These being meetings which are sort of progressing various elements of BRICS and so on and so forth. And there is no doubt that the membership of BRICS will be expanded even further. So I think from 10, we're probably going up to, I don't know. I mean, we could easily see it somewhere between 15 and 20. Mm-hmm. So that's that I think is the extent of it so far. Your question basically being the move towards gold backing of currencies. I think there will come a point when the collapse of the dollar and Western currencies, because the dollar goes down, the rest of us will go down with it. There will come a point where both Russia and China will move from trying not to if you like, change the world in currency terms to protecting themselves from what's actually going on in the West. And the only way in which they can do that is to put their currencies on on a proper gold exchange standard. Mm-hmm. Now, whether they get it right or wrong from the start, I would have my doubts whether they will get it right. But the point is that Russia has the gold. Apart from the reserves at the Central Bank of Russia, they've got two sovereign wealth funds which contain gold as well. And my information is that their total holdings are in the region of about 12,000 tons. Now, that's more than the declared holdings of America. China, I believe, has accumulated very substantial quantities of gold. before allowing her own citizens to accumulate gold, which for which the Shanghai Gold Exchange was set up in 2002. Before then, it was illegal for an individual to hold gold in China. I think that by 2002, bearing in mind that we were talking about a bear market in gold, which fell from a high of $850 down to $250, in 2002, China, I believe, accumulated in the region of 20,000 tons, which it distributed around various government accounts. So you don't see it in the official reserves. Since then, I believe that she has accumulated more. She's got her own mine production, which has been running at anything between 300 and 450 tons a year. And on top of that, she has been importing doré from elsewhere to refine, and that doesn't leave the country. So she has been like a black hole sucking in gold from the rest of the world for some considerable time. So she can go on a gold standard tomorrow without any doubt whatsoever. But knowing the Chinese government, she will not actually allow proper convertibility. So we have to see how that actually works out. Now, the important point, Tom, is that if we talk about Russia, China, and BRICS, we're talking about, 60% of the world's population, 70% of the world's population represented by these nations. If you look at the Chinese economy, officially it's smaller than the US economy. But if you look at it on a purchasing power parity, which is the best way to look at it, it's actually far larger than the US economy. So, while we in the West are sinking, there is a new world out there, rising and rising and rising. So this is good news, because you don't want everybody to sink at the same time. That would be the end of the whole thing. So there is going to be a future, I think, courtesy of China and Russia. That is, of course, if we don't start chucking nuclear war stuff around, which is an increasing possibility.
Absolutely. And hopefully cooler heads can prevail and we can relearn the art of diplomacy between the West and the East and all of these different powers that be right now.
Yeah, relearn the powers of diplomacy, relearn economics. There's an awful lot of relearning to do, I'm afraid.
Well, unfortunately, I think some of those lessons are going to be forced upon, all kinds of different people, and unfortunately probably slapped in the face with it before we have to learn it. There's what's that saying? The gist of the saying is that we've finally come to the right answer after exhausting every other possibility.
Every other possibility, yeah. I think Churchill said that of the Americans.
Right. Yeah.
Yeah, well, it's true of all of us, isn't it? I mean, but, we only wake up when we actually have an enormous crisis. And I suspect this one will go in two phases. Crisis first, response. Response will be just chuck money at the problem, collapse the currency. Mm-hmm. Only then can we get a recovery. We'll be like a phoenix rising from the ashes, hopefully. Mm-hmm. But governments stand in the way of it. I mean, that's the real problem. It's governments. We cannot afford our governments.
That's a great way to put it. Mm. From a mistake standpoint, from a fiscal and monetary standpoint, from a freedom standpoint, from all of it.
Yeah, absolutely. And in a sense, the quicker this happens, the better, because then we can get on with our lives.
Yeah, exactly.
I mean, it's not a nice prospect, but when you see governments just getting worse and worse and worse and worse, it's probably better to put a stop to it. Let events put a stop to it sooner rather than later, because I don't know about you, but I'm in my 70s. I actually want to see a better world. The way we're going, I might not survive until we see a better world. So,
Mm-hmm. Well,
let's.
Here's hoping, Alasdair.
Here's hoping.
Yeah,
indeed.
Of course, for anybody that wants to find more of Alasdair's writing, excellent articles, those are all available at goldmoney.com. And of course, your recent Substack, alasdairmacleod.substack.com, and of course on Twitter as well, at MacLeod Finance. Alasdair, thanks so much for your time today and walking us through all of these issues from your point of view.
Great. Okay, right. Well, thanks for that.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.